I basically agree with your description that it seems demonstrably most of the value sits either at the bottom or at the top, but you don't really want to be sitting in the middle.
The payment methodologies are extremely fragmented, right? If you've tried to move money in the legacy system around, so everything just gets hyper fragmented.
The sweaty moment when you're waiting. I just remember moving something from ETH to Arbitrum and then trying to move it back, and it's a 7-day wait, and you got to put a reminder in your calendar.
Isn't there going to be a lot of people coming for this market? How do you think about that playing out as we scale from 10 billion to 100 billion to trillions?
How do you think we see this market structure evolve? As we continue to see intense protocols scale more and more with more volume. Welcome back to The Rollup. I'm Robbie.
I'm Andy. Robbie and I met at the University of Florida in 2017, where we first found out about digital assets.
We learned a lot along the way, and we're bringing you face to face with the leaders of our industry.
Sit back, relax, and enjoy today's episode. All right, gentlemen. Investing in Intents. Haseeb, Avichal, Matt. Guys, great to be back here. Matt, I think it's your first time on the show. Would love to just get a quick intro about who you are, what you do, and then we'll get right into it.
Thanks, Andy. I'm Matt Kummel. I'm the Chief Commercial Officer for the Near Foundation. I joined over the summer in July. I have been in crypto since 2021. I spent a long time at DCG. Prior to that, long career in consulting and traditional finance, hedge funds, banks, and that world. So this is the place that I'm most excited to be. The whole concept of Intents is the reason I joined Near. So I'm really excited to be talking about this today.
Beautiful. Gents, we're going to talk about investing in the Intent stack, where we see value accruing, generally how we're thinking about it. We framed this to a set of application builders earlier on the show, and just kind of speaking about how it seems like the industry has conceded that intents are indeed the end game for interoperability, for payments, for cross-chain swaps, and just generally the best form of bridging that we've seen since the inception of basically the multi-chain world. We kind of had a good debate about it, going back and forth about there's a lot of nuance to that take. You guys are obviously very, very familiar with Near Intents and just generally the cross-chain landscape. I'd like to get each of your takes on why or what you believe to be the current status quo for interoperability and for cross-chain value accrual, right? I think a lot of these applications in the interop stack have struggled from kind of being in the middle. Kind of, you've got the base layer, the L1s accruing a lot of value, and you've got the applications that own users accruing a lot of order flow as well. In the middle has been kind of a sticky spot for a lot of teams. How do we think about the current state of the status quo of investing in this kind of in the middle stack with regards to intents? And I'm sure we'll go from there. Haseeb, why don't you kick it off?
Yeah, so we're long-term investors in Near. We actually invested back in 2019, it must have been, in the seed round. And Near has obviously evolved quite a bit since then.
Well, you did Near Metastable back in
Metastable, correct.
18.
Was it 18? Yeah, it must have been 18.
Yeah,
That's right.
We did it in 18 too.
Yeah. So I think we were in that same round.
We coded that round with you and Evolve.
That's right. And at that time, I mean, Near was totally different. And so Intents was something that really evolved out of the product exploration of Near in that time. And it's one of these happy accidents. This often happens in startups, is that you start trying to do something and you end up finding this auxiliary thing that actually ends up becoming the real thing that consumers want and pull out of you. So from our perspective, investing in Intents, like our original investment in Near was not predicated on Intents, but it's now become increasingly clear that, as you mentioned, a lot of the middleware, if you're investing particularly in like a solver or these are not where the value is primarily accruing. If you think about the Zcash rise over the last few months, so much of that, the rise of Zcash has been captured, one, obviously by Zcash itself, second, by Zashi, which is the application that actually routes or that sources the demand from users. And then third, Near itself, which facilitates all the solvers coming together and actually settling transactions through their MPC network. But although there are other startups and other companies that sit in between somewhere along that stack, I basically agree with your description that it seems demonstrably most of the value sits either at the bottom or at the top, but you don't really want to be sitting in the middle.
Yeah.
I think about it a little bit differently. I think there's like 4 players when you're talking about an intent. You have the app and the wallet that owns the end user, that owns that relationship with the consumer. You have the intent protocol that is coordinating and solving and finding the path between the user's desire and the liquidity. You have the solvers, and then you have the other L1s and protocols that are there. And so, having looked at this, Haseeb, like the app absolutely deserves to get a lot of the value accrual here, because they own the relationship with the user. There's a lot going to the solvers as well. If you can run an efficient solver, we have 40 plus solvers running on Intents. There's a lot of value that gets captured at that level. There's a little bit in that middle piece in the intent protocol. We're trying to figure that out right now. We have done $10 billion, $11 billion of trade routing through there, and we're working with our partners to make sure that we get the right part of that. And then, the protocol, the L1 at the very bottom is actually not getting as much as you might expect. They're kind of getting gas fees, and that's about it.
Yeah, sorry. So when I was saying the solver, the solver network, I was referring to as the bottom layer, which is actually like managing and routing all of this. That would be near in this case, not the chain that you're moving from or moving to. Those chains obviously are getting almost nothing.
Yeah. Well, I think there's a market structure thing here too, which is, in a lot of markets, this is the case where you sort of like, I can't remember if I published this or if there's an internal thing, but I've talked about this on a bunch of podcasts where you kind of have this like x-axis, which is users on one end and like heavy capex infrastructure investment on the other end, and you put a y-axis on it for who captures the value, and you do get like this U-curve in many markets. So NVIDIA captures all the value, AWS, which is a hard capex problem, captures all the value, and Facebook will capture a bunch of value on the front end, or Claude, will capture a bunch of value. Claude Code will capture a bunch of value. And if you're like in the middle and you're a systems integrator, you're in a tough spot. I think there are two things though that are sort of asterisks on this. One is, even if that's the relative shape, the total size of the market is a consideration here, right? So if you're talking about a really tiny market, like the middle is not going to capture that much. If you're talking about something that's like trillions of dollars, actually the middle could still be like a $50 billion company. Right. So one thing to think about is like, what is the scale of what you're talking about? So even relatively speaking, okay, great, Bitcoin's going to be worth 50 trillion, but actually that might mean that something that we would sort of call middleware might still be worth hundreds of billions of dollars. Right. So there's a scale question. The second thing I think to note is that that's not universally the case, this sort of U-shaped curve. And I think it's a little bit of a function of how fragmented are either ends. So one example here would be Stripe, which is Stripe captures a crap ton of value, and it's because it's so fragmented on both sides, right? There's millions and millions of app developers and people that need to do this sort of processing. And on the other side of it, if you're trying to do this at global scale and you're trying to do this with real users, the payment methodologies are extremely fragmented, right? If you've tried to move money in the legacy system around, so everything just gets hyper fragmented. Or like Twilio used to be a good example of this. The market structure has evolved over the last 15 years, but so many app developers on one side, and so many places to route the messages, and like the nuance and complexity of doing that is to do it reliably is quite hard. And I think you can make an argument that intents look a little bit more like a Stripe or a Twilio than like traditional middleware, which is if you believe there are going to be millions and millions of developers trying to route stuff through networks, and actually there's going to be thousands and thousands of chains between L2s and L1s and specialized chains and permission chains, yada, yada. You actually have a fragmented market on both sides, which actually suggests that maybe intents could capture a lot of value in the middle, and nears the routing mechanism looks a little bit more like a Stripe or a Twilio than it does like a traditional middleware company. You guys are nodding, so I assume nobody disagrees with me.
I think I just feel right now it seems like, based on what Matt said, like there's just been like the question, like the issue now is, okay, how do you meaningfully monetize this? Like there's a moat from the perspective of like Near has some of the best chain routing infrastructure, right? You can go from Zcash to Bitcoin to Solana to Ethereum to a ton of L2s, other non-EVM chains. But as a user, like, is my interaction with this application going to change if there's a additional fee added, and like how that kind of plays out from the perspective of like, is there a moat that is monetizably defensible, or is it just because right now it's a really great spot to go and do this crushing action? But if there's somebody else who has a very similar application with smaller fees, is there going to be a discrepancy in terms of like where users want to go? I guess like what I'm trying to ask here is like, is it just the best product on the market right now for people to use to go from Zcash and kind of like these silos, or is it a really, really good product that can also then start to like charge and actually create a sustainable kind of like revenue source from this?
The story on these kinds of things is always that you get to scale and you make it up on scale. It's very seldom the case unless you're Coinbase, that you're going to have super high margins and that's how you're going to end up building a big business. If you look at the big exchanges in the world, you look at the Binances, the OKXs, the Bybits, they have very low fees. They compete on fees. There's constant fee competition. But that doesn't mean that these are small businesses. Actually, they're tremendous businesses, extremely profitable. So I think the story for Near Intense is no different than that, is the demand for assets moving cross-chain. And basically the kind of, the problem with DEXs historically has been that, okay, you can do spot DEXs. Spot DEXs are great, but they're constrained in the number of assets they can list. If you go on Binance, the kind of assets you can trade is basically everything in crypto. But if you are on, if you're in DeFi and you're trading on Uniswap, you can only trade assets that are tokenized on Ethereum. So you can trade WBTC, you can trade ETH, obviously, Wrapped Soul, there's some of that. But the further down you get on the list, once it's no longer Ethereum based, you're kind of screwed, or the liquidity is so thin and it's so annoying to have to wrap and unwrap and figure out exactly what you own and how to get it out, that what really people want is the centralized exchange experience, which is just, I'm actually trading the underlying. And that's, I think, part of the reason why Near Intense has taken off is it's so simple. You're actually trading the underlying. And that's what people want in a spot experience.
Hibachi is fast and private perps trading, secured by ZK with Celestia underneath. Go to hibachi.xyz to start trading today.
Not your keys, not your coins. From the team that pioneered cold storage, Trezor has just released its new wallet. Guys, if you are still using hot wallets in 2025, 2026, you are missing the entire point. Secure your coins. Get a Trezor at trezor.io.
YEET is built for big moments. The most fun you'll ever have with your crypto. Go to yeet.com to yeet into your next game.
And this holds true to the neo-finance thesis that we have here, which is sort of this maturation of a lot of the old crypto infrastructure that never really found product market fit. And then on the other side, the legacy finance that we think is going to be forced to innovate, whether through regulation or the disruptors that are out there. Ultimately, people want the centralized exchange experience. But thinking about value accrual in the stack, we do have some data behind this. Matt, like you mentioned, $10 to $11 billion of volume flowing through Near Intense has generated $18 million in fees. This over 500,000 unique users in the last 30 days, 100,000 users in the last 7 days, over 16 million total swaps. So I'm curious about how the market structure evolves when we have sort of this multi-dimensional market between like this Intense protocol and the solvers, for instance, as one dimension of this. Like how do those negotiations take place? Are we running these auctions behind the scenes? And it's a matter of, these solvers holding inventory and this is how the market structure shakes out? Or, what are these kind of like B2B, like people sit down in a room, they hash this out face to face in terms of negotiations? How do you think we see this market structure evolve, as we continue to see Intense protocols scale more and more with more volume?
It was funny, just taking a clip from what Haseeb said, we'll make it up on volume. There's a funny thing there where it's like, we have not been taking fees on a lot of this stuff. We've been creating the relationships, creating the network. And, it was mentioned earlier, sort of the Zcash moment was the catalyst for Intense for us. I was really worried that the analogy I use, and this is kind of a gross one, but I thought it would be like a snake swallowing a hamster, and you would just see this lump of Zcash thing going through, and then we would have collapsed back to where we were. And I think the team that I work with here at Near did such a tremendous job of capitalizing on that moment and finding the partners and working with partners and building those relationships. And so a lot of it, Robbie, is one-to-one negotiations. It's not exactly where I want to be. I'm trying to get to more standardized relationships and more, fair sharing of value between the different parties that are in the ecosystem. I want that value to accrue in a transparent way. I want Haseeb, I want Avichal, I want investors out there to see what we're doing. Like, my dream is for someone to be able to do a DCF on the Near protocol. And so I want the revenue to be accruing and to be visible. And so that's what we're working on right now is going out and working with our partners.
There's no specific agenda, right? It's everything.
It's price and it's value that you're delivering to the end user. Like that's how the decision gets made.
Okay,
That's how they choose their routing. No one is sitting there in the Ledger wallet or the Trust wallet going, I'm a near intense user. They're going, that's the best price. I'm going to bang it. And I'm going to close that.
Okay. Thank you. Thank you so much.
So we have to be competing on value and that value has to be, shared across those network of partners. And so it's going to be really fun next 3 to 6 months as we go and have those conversations. It's amazing, for us to have our real piece of product market fit for Near and to be seeing it work and to have, runs that you can put up on the board, but also know that you're providing tremendous value for the end user. And I mean, all of us here have been around long enough. You guys have bridged assets. It's a sweaty moment when you're waiting. I just remember moving something from ETH to Arbitrum and then trying to move it back. And it's a 7-day wait. And you got to put a reminder in your calendar. Like that's not good UX. And so that's what we're trying to do is provide a fantastic user experience and provide a thing of high value to them. And I think we can and should get paid for that.
Yeah, definitely. Avichal, kind of coming back to your U-shaped curve idea here with regards to the market structure, specifically within Near Intense, but let's just kind of zoom out to the broader cross-chain landscape and the Intense landscape. And perhaps this is a silly question, but is this just a winner takes most or all market, right? Is it going to be something where, we've seen so many kind of like what Vance from Framework calls Temu copycats of successful applications that get VC dollars because they think that they're able to kind of like, take a small share of a big pie that's been created by the kind of number one here. Near Intense being the leading kind of intent cross-chain provider amongst tons of other cross-chain providers. How do you see the competitive landscape for Intense playing out? If we're convinced that Intense are likely going to be the at least part of this end game of the cross-chain abstraction that we've been looking for, isn't there going to be a lot of people coming for this market? How do you think about that playing out as we scale from 10 billion to 100 billion to trillions?
Yeah, I think there will likely be people that try. I think with these kinds of things, though, there's a real network effect. Like if you assume that the market is going to be fragmented on both sides, then there is a true network effect phenomenon, which is why I really agree with what Haseeb was saying, which is I think you don't want to worry too much about value capture on the front end. You just want to get to scale. And sprinting as hard as you can to get to scale means you lock in the network effect. And then if there is a true network effect, which I think there is here, between the applications and all the chains across which you need to route, then that almost always results in some significant efficiency. Could be depth, liquidity, pricing advantages, settlement times. There's like a lot of dimensions of efficiency you might get, but that network effect will give you all of that efficiency. And then at that point you have pricing power. And I suspect this is going to be a winner takes most. Like it's likely some sort of power law where the winner for whoever is routing across all the chains and across all the devs and settling all of this stuff, that likely is like the winner takes 70 or 80% of the market. And then there will be some specialized, 20% that's scattered between a couple other folks, but it's going to look, like social networking or payments or search. Like it's going to be a power law. And I think that's what I'd be focused on if I were the Near team right now. It's just like market share. How do you just get to max market share? Because, the market here is going to be 100x, 1,000x, 1,000,000x bigger than it is today. We're still very early days. And that early network effect will compound. So if you can be like Facebook and just win colleges, you can take that and you can back into everything else. And then as the market grows, then you win. Then you're $1 trillion company.
Yeah.
So if
there's two things I want to add to that is that, imagine an alternative world where Near was charging super high margins and they were making a bunch of cash. That's actually the world where you want to be more afraid of competition because everybody's going to see huge target on your back. People are going to come and undercut you. They're going to try to compete for that margin. But if you start super low margin and you basically say, I'm going to go low margin or even go zero margin and just dominate the market first, then all your competitors are screwed because nobody can come in and really compete with you. And if they do, unless they get to scale more than you, there's no prize waiting for them at the end. So that, it's hard to compete with free. And this is one of the things that social networks learned very early on is that like, yeah, don't charge anything, just get to scale, dominate the market. So I like this version of the world where Near is basically just completing and dominating the market. The second thing I'll say is that, one thing to recognize is that we've seen this enormous growth in perps and in perps on chain. And this is in large part because, these are cash settled instruments, very, very easy to do on chain. Not very easy, but obviously straightforward enough, because all you really need is to know what the mark price is, to have some funding rate, to have enough liquidity for the market to clear, and boom, you can trade anything. But the problem with that theory is like, okay, yes, you can trade anything, but you can only trade the price. You can't actually get the thing that you are buying. You cannot get Zcash through Hyperliquid. And if what you want is a property of the underlying thing, like if what I want is privacy, you don't get privacy by swing trading Zcash on Hyperliquid. You only get privacy by actually getting the Zcash. And so as we start thinking more deeply about why people are using crypto and what they're using crypto for, it's like, I don't want to be long a USD perp. I want a stablecoin. And that's a big part of the reason why the DeFi story of just the rise of derivatives is not enough to satisfy the whole picture of why DeFi is so valuable and so important. The other side of that is the physically delivered stuff. That's what Near Intense is all about.
So then would a structural risk to the Intense thesis being that users don't actually care that they get the actual asset?
Yes, that would be a huge structural risk. I don't think we're that much worried that will happen. I think it's pretty clear that people, you can see already from the underlying demand that, people want to use stuff that's available on other chains, right? I don't want Wrap Sol if I want to go onto Solana. I actually want Sol because I can't pay fees with Wrap Sol.
Looking for yield that stands out? infiniFi gives you just that. Deposit stablecoins and earn far more than the current savings rate. infiniFi is a battle-tested, reliable DeFi platform that is ready to go. Head to infinifi.xyz.
Halliday is unified crypto payments. Give your users more wherever they are. Go to halliday.xyz to never write a smart contract again.
Trade on anything. Economics, weather, sports, crypto, and more. All on Kalshi.com 24/7 for the world's biggest prediction market. So outside of the competitive pressures then, guys, and the actual asset issuance, what are the other structural risks that you see from the investment perspective for Intense as a category? Is it other bridge designs winning out? Is it the multi-chain landscape kind of fails and we get a lot of consolidation across activity into just a handful of chains? Is it some sort of structural third party, I don't know, going like solvers going on strike and being in a union? Like, what are the other structural risks to this thesis outside of competition, fees, and asset issuance or asset types? Or is there any?
I think we're on an inevitable path, right? DeFi is 25, 26% of daily trading. That's up 6x over the last 3 or 4 years. We're going to see more and more people moving into DeFi. As Haseeb just said, like, people want access to the raw underlying asset. They don't want the wrapped asset. They don't want the derivative of the asset. They want the asset. They want to hold it in their wallet. They want to know that they own it and it's safe. I think Intense grows. For me, like, Intense is not just a swapping mechanism. It's not just a crypto mechanism. Our long-term vision is this becomes the commercial arm for the artificial intelligence agents and transactions that are coming. And you'll see us build out Intense in that way. So we'll move from just a on-the-spot swap between Haseeb and I to a escrow transaction between Haseeb and I to a contractual relationship between Avichal and myself. Like, that's where we're going to see it going. We're going to see it move into physical goods. And this was a tremendous proof point, but that's the long-term vision.
Hey, how's it going?
That intent concept.
I would add kind of two things. One, I think DeFi is certainly going to take off. I think TradFi is coming in. Like, this is, when we talk to people in New York and Wall Street, like, they're going to tokenize everything. It's very clear.
I don't know if I should tell
and
you
that has to
here,
sit
but it
somewhere.
sounded like the
I don't
like
think it's going to
over
be that
Hibachi.
there's just like one chain where all the tokenized stuff sits. There's just too many competing
Like
interests.
5 minutes ago?
It's going to be complex, right? I think it's going to be many, many chains, many, many base layers, many L2s, many L1s. And so I think that fragmentation creates opportunity for intents. The other thing to think about here is the rise of agents. And I think the agentic economy, while very, very nascent right now, I think if you look at any other financial market, if you look at the stock market, it's mostly algorithms.
Yeah, one of my
not
devs
mostly
just said
humans.
you're live.
So we're used to this world where there's like a bunch of humans clicking on buttons in DeFi. What we're about to hit is this world where it's all bots. There's obviously a bunch of bots at the MEV layer and like in transactions right now already, but like when you can vibe code a bot that just does a thing on your computer, or every single app has some agentic interface, I think you're actually talking about like an entire TAM expansion of 1,000,000x, right? Like I think the actual users of this stuff are not quite here yet. And once the agents are here, now you're talking. And I think that happens over the next like 2 or 3 years.
Avichal, I'm still thinking
last
about
thing I'll say, last thing I'll say, just to put a bow on that, is the reason why intents. Just to hammer this one more time. Like even if you just want exposure to the price, right? Let's say I'm buying Bitcoin, and I'm not buying Bitcoin because I'm going to be using Bitcoin fees to transact on Bitcoin, but I just want to own the Bitcoin, right? Even in that world where I just care about the price, if I'm an agent or if I am, somebody that just doesn't really, look, Hyperliquid's a great exchange, but if I want to own this Bitcoin for multiple years, do I really want to have an open derivative position on Hyperliquid for years? Like, do I know what that's going to look like? Do I know what the funding rates are going to be? Do I know that the exchange is going to stay up? Do I know what's going to happen to my positions? Do I know there's not going to be a Hyperliquid V3 or a V4? I don't know any of that. I don't care about any of that. I don't want to know about any of that. All I want to know is I have my Bitcoin and you leave me alone. And so the instantaneous trust I have to have of simply, does this intent network work? Am I getting a good price? That's the only thing I need to know. The moment I have that interaction with the intent network, I am done. All I have now is Bitcoin. All I have now is Zcash. All I have now is the tokenized stock. Even if I'm an institution, I don't want to have a long-term position open on some DEX. I just want the tokenized stock. Give me the tokenized stock. I want no further counterparty risk than whoever actually did the tokenization, the end. That fundamentally is why I think this stuff is going to continue to grow. Institutions care a lot about counterparty risk, to say nothing of individuals.
Gentlemen, thanks for joining. It's the Intense Day special today. It's a bit of a mega stream. Thank you for being a part of it. Congrats on the success on this investment. Matt, great work. Always good to have you. Always good to have you guys.
Pleasure, guys.
Right. Shout out to the clean room guy.
Alex.
Behind the scenes cooking.
Cheers, guys.
Sweet.